Italy's public debt is not just high, it is colossal, sitting at more than 140% of its GDP, one of the highest ratios on the planet. Behind this number lies a painful history of structural weakness and decades of economic stagnation. Since the 1990s, Italy's economy has grown so slowly that analysts often call it the sleeping giant of Europe. But this sleeping giant is drowning in obligations it can no longer afford. A major reason for Italy's exploding debt is its aging population. Italy is one of the oldest nations in the world, with a shrinking workforce supporting a massive pension system. Every year, more Italians retire than enter the workforce. The result? More government spending, less tax revenue, and deeper deficits. Add to this the political instability that has haunted Italy for decades. Over 70 governments since World War II. Frequent leadership changes disrupt long-term reforms, making it impossible to fix structural problems like low productivity, rigid labor markets, and weak innovation. The country's once dominant industries, textiles, automotive, manufacturing, have lost global competitiveness. Meanwhile, the South remains economically fragile, forcing the state to spend billions in subsidies and support. The consequences are severe: rising borrowing costs, declining investor confidence, and constant pressure from the European Union to cut spending or raise taxes. Public services weaken. Youth unemployment remains high, and families feel the weight of a system that seems unable to protect their future. If Italy cannot reverse these long-term trends, its debt crisis could destabilize not just Italy, but the entire Eurozone. The question now is not whether Italy is running out of money, but how long it can keep holding everything together. Italy suffers from one of the slowest economic growth rates in the developed world, and this single problem is at the core of its wider financial crisis. Since the early 2000s, Italy's average annual GDP growth has hovered around 0 to 1%, far below the EU and global averages. Over an entire generation, Italy's economy has barely expanded at all. This stagnation means fewer jobs, lower wages, weaker tax revenue, and ultimately, a government that is slowly running out of money. One major cause is extremely low productivity. Italian companies are dominated by small family-owned firms that struggle to scale, innovate, or compete globally. Modern sectors like technology and advanced manufacturing remain smaller than in rival economies such as Germany or France. As industries fail to upgrade, workers remain less productive, which keeps wages low and growth stagnant. Another long-term factor is bureaucracy and rigid regulation. Starting a business, hiring employees, or expanding operations often requires navigating slow and complex legal systems. Investors frequently avoid Italy because every project feels like a battle against paperwork, uncertainty, and political instability. Emerging industries, AI, robotics, renewable energy, grow slowly in Italy, leaving the country behind in the global technological race. Meanwhile, the aging population reduces the size of the workforce, making growth even harder. The consequences are profound. Youth unemployment stays alarmingly high. Innovation falls behind Europe. Government debt grows faster than GDP, making the financial burden heavier every year. Investors hesitate, fearing that a stagnant Italy cannot pay its obligations. Slow growth doesn't make headlines like sudden crashes, but it is far more dangerous. It quietly drains a nation's strength until one day the money simply runs out. Italy's rapidly aging population is one of the most severe demographic crises in the developed world, and a major reason the country is running out of money. With a median age of around 48, Italy is among the top 3 oldest nations globally, and its birth rate has collapsed to just 1.2 children per woman, one of the lowest on Earth. In many regions, more people die each year than are born, creating a demographic imbalance that is slowly suffocating the economy. The core problem is simple: too few workers, too many retirees. As millions of Italians retire, the government must pay massive pension and healthcare costs. Meanwhile, the shrinking workforce means fewer people are contributing taxes. This creates a widening financial gap, an economy expected to support obligations that grow every year while its productive base weakens. Entire towns in southern and rural Italy are becoming ghost communities. where the average resident is over 60 and local schools shut down because there are no children left. Young Italians often move abroad for better salaries, draining the country of its most productive demographic. This brain drain further reduces innovation, entrepreneurship, and long-term growth. The consequences are severe and long-lasting. The pension system becomes unsustainable. Healthcare spending rises sharply. The government must borrow more, increasing national debt. Businesses struggle with labor shortages. Consumer spending declines as older populations spend less. And aging Italy means a slowing Italy, economically, socially, and financially. The country is not just running out of money, it is running out of the very people who create it. Italy's political instability is one of the most destructive forces behind its economic decline. Since World War II, the country has changed governments more than 70 times, creating one of the most unstable political environments in the developed world. This constant turnover means policies rarely survive long enough to take effect. Every government arrives with a new agenda, only to fall before reforms can be implemented. This instability has paralyzed Italy's ability to modernize its economy. Major structural issues, low productivity, rigid labor markets, outdated regulations, require long-term strategies. But when prime ministers change every 12 to 18 months, continuity becomes impossible. Investors hesitate because they cannot predict tax laws, labor rules, or economic policy. Businesses delay hiring and expansion because each new coalition signals uncertainty. Political fragmentation makes this worse. Italy's parties are deeply divided, often unable to pass meaningful reforms. Coalition governments frequently collapse due to internal disagreements, leaving critical policies stuck in political limbo. One example is Italy's pension reform, which has been changed, reversed, and modified repeatedly across different governments. Another is tax reform, which has been proposed dozens of times but rarely implemented fully. These policy reversals erode confidence in Italy's long-term direction. The consequences are heavy. Lower foreign investment due to unpredictable policy. Slower economic growth as reforms never stay long enough to work. Rising debt because governments prefer short-term promises over long-term sacrifice. Higher borrowing costs as markets distrust unstable leadership. Public frustration, especially among youth who see no consistent future. In the end, political instability becomes an economic trap. Without stable leadership, Italy cannot change course, and the country continues drifting toward a financial breaking point. Italy's heavy tax burden combined with a weak business environment is a core reason the country is running out of money. Italian companies face some of the highest corporate and value-added taxes in Europe, while workers are subject to extremely high income taxes. For businesses, every investment is met with fees, bureaucratic hurdles, and delayed approvals. For citizens, salaries are drained before they even touch their bank accounts. This creates a vicious cycle: less investment, slower growth, and higher public debt. The business environment is highly restrictive. Starting a company requires navigating a labyrinth of regulations. Hiring employees, exporting goods, or securing permits is often slow and unpredictable. Small family-owned firms dominate Italy, but scaling them or innovating is difficult. Foreign investors often hesitate, fearing regulatory uncertainty and slow judicial systems. Long-term trends amplify these problems. Decades of weak reforms, coupled with rigid labor laws, discourage innovation and entrepreneurship. Italy ranks low in the World Bank's Ease of Doing Business Index, highlighting systemic barriers to growth. Meanwhile, young, talented Italians migrate abroad in search of opportunity, draining the country of its most productive demographic. The consequences are severe: reduced investment in business expansion, slower GDP growth, rising youth unemployment and brain drain, increased government borrowing to cover structural deficits, an economy that stagnates while debt continues to rise. High taxes and bureaucratic obstacles do not just slow Italy's economy, they choke it. In a nation already burdened by debt, an unfriendly business environment ensures that money leaves slowly but relentlessly, threatening Italy's future. Italy's financial crisis is not just self-inflicted. EU restrictions on spending and borrowing add another layer of pressure, limiting the government's ability to respond to economic challenges. As a member of the Eurozone, Italy must adhere to strict fiscal rules, including the Stability and Growth Pact, which requires budget deficits below 3% of GDP and public debt below 60% of GDP. With debt exceeding 140% of GDP, Italy is far above this limit, leaving little room for maneuver. These restrictions are intended to maintain the stability of the euro and prevent reckless borrowing, but for Italy, they have unintended consequences. The government cannot freely invest in infrastructure, healthcare, or job creation programs without risking fines or losing market confidence. Every euro spent is scrutinized, and ambitious reforms are delayed or watered down to satisfy EU criteria. Long-term trends exacerbate the problem. Italy's persistent slow growth, aging population, and weak productivity make economic expansion difficult. Yet EU rules limit the government's ability to implement counter-cyclical policies, such as stimulus spending, to jumpstart the economy. When crises hit, like the 2008 financial crash or the COVID-19 pandemic, Italy must rely on debt markets and EU emergency mechanisms, which are slow, conditional, and politically contentious. The consequences are stark: inability to invest in long-term growth projects, persistent public frustration over austerity measures, higher borrowing costs due to market uncertainty, growing pressure on social programs, especially pensions and healthcare. EU restrictions create a paradox. They prevent Italy from overspending, but they also prevent Italy from acting boldly to solve the very problems that generate its debt. For a country running out of money, these limits turn every fiscal decision into a high-stakes gamble. High youth unemployment in Italy is both a symptom and a driver of the country's financial crisis. Approximately 30 to 35% of Italians under 25 are unemployed, one of the highest rates in the European Union. For decades, structural issues in education, labor markets, and the economy have prevented young people from entering the workforce efficiently. The result is a lost generation, both economically and emotionally. One major cause is rigid labor laws, which make it expensive and complicated for companies to hire young or temporary workers. Combined with a weak business environment and high taxes, firms hesitate to create new jobs, particularly for inexperienced workers. Many young Italians end up in precarious, underpaid positions or leave the country entirely. The long-term effects are devastating. A generation without stable employment cannot save, invest, or buy homes. This reduces domestic demand and slows economic growth, contributing directly to Italy's budgetary problems. Families face growing financial stress, and social inequality widens. The brain drain phenomenon intensifies as talented youth migrate to Northern Europe or the Americas, leaving behind an aging, less productive population. The consequences also echo politically. Disillusioned youth are less likely to participate in civic life, weakening social cohesion and amplifying instability. Economically, high youth unemployment strains public finances through increased welfare spending, while simultaneously shrinking the tax base. In short, Italy's high youth unemployment is a ticking time bomb. It not only steals the hopes of a generation, but also drains the country's financial energy, making recovery increasingly difficult. Without addressing this crisis, Italy risks losing the very people who could secure its future. Italy's banking system has long been a cornerstone of its economy, but today it is one of the country's greatest vulnerabilities. Italian banks are burdened with high levels of non-performing loans, NPLs, totaling over 150 billion euros, a legacy of economic stagnation and poor lending practices. These bad debts limit banks' ability to lend to businesses and households, slowing investment and consumption, and directly contributing to the broader economic malaise. Structural weaknesses compound the problem. Many Italian banks are small and fragmented, with limited capital reserves compared to their European peers. Governance issues, outdated technology, and historical exposure to regional economic disparities reduce resilience in times of crisis. During financial shocks, like the 2008 global recession or the COVID-19 pandemic, these banks struggled to support companies, leaving many small businesses vulnerable or bankrupt. The consequences are far-reaching. Weak banks depress economic growth by restricting credit, particularly for small and medium-sized enterprises, SMEs, which are the backbone of Italy's economy. Investor confidence falls, increasing borrowing costs for the government. Households feel the pinch as mortgages, loans, and financing options become more expensive or harder to obtain. Long-term trends, including Italy's aging population and slow GDP growth, exacerbate these weaknesses. With fewer young people entering the workforce and a shrinking economy, banks face increasing pressure to maintain liquidity while supporting social and economic demands. In essence, a weak banking system becomes a self-reinforcing trap. Banks cannot lend, businesses cannot grow, the economy stagnates, and the government must borrow more, driving Italy ever closer to a financial breaking point. Italy's industrial competitiveness, once a symbol of global leadership, has declined sharply over the past 2 decades, contributing directly to the country's financial crisis. Italy's manufacturing sector, particularly in automotive, machinery, and textiles, struggles to compete internationally due to high labor costs, rigid regulations, and outdated production methods. This decline limits exports, slows GDP growth, and reduces tax revenue, exacerbating the nation's debt problem. One major factor is investment stagnation. While Germany, France, and emerging economies invest heavily in automation, technology, and research, many Italian companies remain family-owned SMEs with limited capital for modernization. As a result, productivity growth lags behind European peers. High bureaucracy and complex regulations make it difficult for firms to innovate, expand, or compete globally. Globalization also exposes structural weaknesses. Italian companies face competition from low-cost manufacturers in Asia and Eastern Europe. Luxury brands maintain some global prestige, but mass manufacturing and middle-market industries are losing ground, further weakening the economy. Long-term consequences are profound. Rising unemployment, particularly in industrial regions of the North. Reduced exports, shrinking the inflow of foreign revenue. Brain drain as skilled engineers and managers leave for more competitive markets. Slower economic growth, reducing government revenue, and increasing dependence on debt. Falling industrial competitiveness turns Italy's economic engine into a fragile system. Factories close, jobs vanish, and the country's global influence diminishes. In a nation already burdened by debt, losing its industrial edge accelerates the path toward a financial breaking point, making recovery ever more difficult.